Okay, Brian, mortgage rates in the U.S. decline.
Hey,
I couldn't get through the title. They declined to a 2-month low of 6.875. I mean, look, that's good news compared to 7.25. But people aren't flocking to the real estate market because it's from
0.3, 0.5.
6.9 to 6.8.
Honey, the rates drop.
Like
Call the loan officer.
Like losing their mind. Go now.
Call Brian. We need a refi now.
The decline is just that. It's a decline. It is certainly not it is not like opening up a new basket of money where people are flocking back to real estate right now. Broadly, the people who are coming towards real estate still are looking at it for the long haul, like we've been talking. They're looking to have cash flow, whether it's investment property or buy a place that they can build an ADU on or something like that. And that is the type of buyer that we're seeing, where they're not only buying a house for themselves right now, but they're buying it for some sort of financial purpose later. And that is going to continue, especially when things like this are happening. It's like, the headline is mortgage rates declined ever so slightly. The decline is still a decline, so I'm not going to pull the rug and say it's not a good thing. It is a good thing. It's just not a great thing because it's still really far from where people have their golden handcuffs in the 3s and 4s. Being at the high 6s is great for people getting in now. Yeah, not so hot for people who have got their rate that's a lot lower today.
And one of the things that I like how they mentioned is that, with the rates staying at the levels that they are, one of the things that I wanted to, just clarify is that, just because rates come down doesn't mean they tank like 1%, 2%. But what rather happens is that it gets cheaper to get that rate or that pricing. And what
That's
I
a good
think
point.
What a lot of people don't understand is that when they hear rates drop, they're like, oh, rates dropped, like, oh, they're back to like 5-4%. But in reality, they're just dropping in the cost because you also have to take into consideration that the lowest rate isn't always going to be the cheapest rate as well. Mm-hmm. So one of the things that I liked in the article that they said, make sure that you're cautious about where you're shopping for your rate and you're asking the right questions. I think that it's very important that you should ask for a rate with a discount, rate with no discount, and then rate with credits, so that all the ranges of what's available to you, and not just go with what they say that, hey, you should definitely do this.
Go explain that to people who may not understand what you're talking about when it comes to discount. Explain that kind of not the theory. Explain how it works so people understand what you're talking about, the par rate, and then basically buying down your rate.
Right. So for super simple example purposes, let's say the lowest rate that's able to be given to you today is 5%, but that's going to come at a cost of 1%, 2%, because the bank's saying, we can give you.
Hold on, you're already going ahead. 1% or 2% of what?
Oh, the purchase price.
Okay, let's say you have a $500,000 loan amount.
Yes.
And the market rate is 5%, but it costs you out of pocket or part of your closing costs 1 or 2% of that loan amount, which in this case would be $5,000 or $10,000 to get and secure a 5%.
Yeah.
All right, go ahead.
So let's say you take that route. Great, you're going to be saving in the beginning years, but you also have to pay for that. Now you can also say, hey, what is the rate at par? Meaning that I'm not paying it down. I'm not, I just want to know what it is for me to get the rate at, which is going to cost me nothing. Then you'll see the difference. You'll be like at 5.5 to maybe 5.625 for it to be at a no cost. And then you also have the ability of saying, hey, well, I don't have all of my closing costs, or I would like some of my costs to get covered by credits or seller credits, whatever it might be. You also have the option of saying, hey, loan officer, is there any way that you could provide me with lender credits? One of the two things they'll say is like, we can take that 5.5 or 5.625, and if we take it up to maybe a 6%, we can offer you X amount of credits back so that you use for your closing costs. That in itself, I think, is a huge strategy, because a lot of people will say, hey, I got the extra 1 to 2%. I want a lower payment. Yeah, I'll pay for it. Or you know what? I'm strapped on cash right now. I'll take my par rate and refinance down the line. Or, hey, I need credits. I need help. I could take a little bit payment up in the beginning years, and then I'll refinance down the line.
Yeah.
But you have these options to be able to, minimize your mortgage costs, and more than anything, understand, what you can and can't do. And it also helps out with your payment and, your money that you're forking out for the purchase.
Yeah. So the idea of discount points is so that you can secure a lower interest rate than what the par rate is.
Yes.
And then in the case where the interest rate is higher than par, there's usually money on the table that can be applied towards your credit, your closing costs as a credit. So that's what Brian's talking about there. And for those of you who've never heard that before, as far as mortgage rates declining kind of in like this season of the year, it's summer. That's a good sign. You've seen inventory last couple months kind of creep up a little bit.
Yeah.
You see people getting out there again, especially in places where weather is more of something you have to contend with across the country during the winter and kind of the fall coming into the winter months. So that is occurring. I know that they're saying people are gravitating back towards real estate, but what the differentiator is, they're going back towards places that are ready to go.
Yeah.
So it's like, if I'm going to pay this elevated price at an elevated rate, then the place needs to be done. Now, that leads people towards new development or newer homes, or homes that may be a little older, but they've been modernized, they've been upgraded, and they kind of look the way they would look now in the market, even if it was built 20, 30 years ago. You walk in it, and it looks like, oh, it was kind of built here recently.
Yeah, and I think that's one of the things that people, start to realize, that is, if I'm going to be paying this much for a house, it better come with everything that I need, or everything that I want. And I do see a lot of people gravitating towards, new builds and stuff like that, because of the fact they're like, hey, well, I'm already going to be paying this much for a payment. That's an older house compared to this. I'd rather go into the new build. Now, that's not always, the best case, because there's also fees that come along with buying a brand new house. Like Melrose could be, above $1,000 just in that for property taxes. And then high HOA costs that, tack on maybe another $500, maybe even, $1,500 in just, fees a month to your mortgage payment as well. So, I think it comes to what the people really want. And if they want to transact right now, there's people that want to buy. Is just, it really comes down to the rate, this and that. But the people want to buy. People want to go out there and sell. I mean, unfortunately, the market isn't giving them the opportunities that they want. But the people have that want for wanting to sell their houses, because they're also seeing that, I have a low payment, but I also have all this equity.
Yeah.
You know what I mean? It's like, I got my $2,500 payment, or $200,000+ in equity.
Yeah, there's a big part of this is like, what are you willing to tolerate?
Yeah.
Because I mean, it in the end, if you go to the 30,000 foot level, it's what are you willing to tolerate? If you're renting right now and you're tolerating a high monthly rent, and you're like, well, if I'm going to pay this much, I might as well buy a house. Well, then, okay, I'm going to tolerate that high monthly payment on my mortgage.
Exactly.
Now, if I have golden handcuffs and I got to refinance at 3% a couple of years ago, and I'm holding on to that, well, you're not going to tolerate a 7 or 7% interest rate, or a 6.5, or maybe not even 5.5. It has to be like you must need to get that money out of your house or something, and that's where the equity comes into play, like you're talking about. So
that makes sense.
Broadly, even back at your example at the top of the show, talking about the family where the combined income was roughly $160,000, the monthly payment's going to be $6,500 or whatever. It's like, you have to tolerate that. that has to be like within your limit of accepting that as true for you, and then willing to continue doing the things you got to do to make that payment.
So we recently just helped out a good friend of ours get into their house, and it was two brothers that bought houses. They work for the city, and combined, same thing. I think there were around $150,000 for income combined. Same thing. They live together. My buddy has a kid, has his two kids and his lady that they live with, but they bought together. And the thing for them was that the payment is that $6,500 payment. And, right now what they did is they leveraged those credits that we talked about to bring their rate down the first 2 years and, ease into that mortgage payment in the beginning years of the mortgage. Now, that payment came down still to $5,400.
Hold on. Slow down for a second. Some people would be like choking right now.
Yeah.
Like, what do you mean it came down to $5,400?
Yeah. So we went from a rate of 6.250 down to the first year at 4.250, and still significantly the payment was still above $500,000. The purchase was, I believe, for $746, came in with minimum down payment 3.5%. And to them that was it was a hard pill to swallow, because they also weren't paying, their rent, I think combined was like maybe close to $3,100. Oof. So now having to double that payment when you're getting used to splitting that payment, and that's very, very easily digestible. Now you have to fork twice the amount to be able to, now own your property. But, for them, the situation, like I said, made sense. They needed more space. They just had a new baby. They have the brother that lives with them, and they also have a 7-year-old daughter. So, they needed more space than where they were at. They were at a smaller condo they were sharing. So they said, hey, we realize that our situation presents itself, and this is what we need. I know the payment's that, but what am I going to do?
Yeah, it's what it is.
What I mean? What am I going to do? And when I gave him a call, luckily he's like a really close friend that we grew up with, and it's still a tough pill to swallow, because, the goal is going to be to refinance in about 2 years. But, in the beginning years, that doubt and that, like, who's giving you that peace of mind that it's going to happen, Although we are constantly looking at the market, and, we're going to reach out to them when the opportunity does come. But it's a bit frightening for, going from a $3,100 payment to now double that.
Well, yeah, but on the other side, you kind of like slid it in there. You're like, oh yeah, down to $5,400. Like, down from what? Like, higher than that, number one. But again, earlier in the show, a $6,500 monthly payment all in for this family. Well, $5,400 sounds a lot better than $65,000. Isn't that insane?
And it sucks because insane. It's like, that's $1,000 back in your pocket virtually. So it's like it's
hold
still
on.
a lot, but
it's still 54 going out. Like
I know, but it sounds whatever way you want to put it. It's I'm gonna get cooked in the freaking comments, but it's okay because like unfortunately that's the situation of the reality of right now. And it sucks to say that, like, hey, this is what it is, and I can't believe we're saying this, but it's the truth. We're writing notes at these prices, at these ranges, and
the only solution is more housing. The only solution is more inventory, more development, and I think we're going to see that. We have to turn that corner in the next 12 to 24 months. We just have to. Otherwise, we're absolutely squashing and killing the quote-unquote American dream for first-time home buyers because we're talking about the cost of raising a family of 4 at the top of the show. Now we're talking about mortgage rates still in the high 6s. Even if they're high 6s, mid 6s, low 6s, still in the 6s, fine. But again, at these same prices, with these interest rates, that's not helping people. It's keeping them out. No,
and it's unfortunate because the one thing that we're supposed to be doing, ramping up starts for single family houses or just multiple homes in general, it's really slowed down, and that's the one solution to a lot of things. And once our other problem of rates come down, it's only going to put more pressure on this problem because it's not happening as quickly as it should be. And again, it goes back to higher for longer because one thing drops, but the other one's going to stay right the same. Yeah.